Hey everyone, this is Joey from Pantera Capital. We're gonna go ahead and get started. So the investment team of Pantera, Pantera was originally founded 15 years ago by our CEO, Dan Moorhead, who started the firm back in 2003, originally investing in global macro, kind of big thesis plays, eventually things like Tesla Motors, kind of interesting one-off big macro trades. And then in 2013, decided to pivot the firm entirely to cryptocurrencies and digital assets like Bitcoin, because he had basically got introduced to Bitcoin in 2011. And then by 2013, decided that it was the kind of biggest macro trade that he'd ever seen. And so basically closed the old fund down and pivoted to crypto. And so the current team, Pantera, includes 25 employees, including myself, and then also Paul Vereda-Talkett, who's another partner at the firm, and then Lauren Stefanian, who's an associate, and William Fan, who's working on the digital asset fund strategies. And then on the management side of things, we have Bill Healy, who has a bunch of experience from Deutsche Bank, Matt Gorham, who's been with Dan, handling kind of financial things of the funds since 2003. Ryan Davis, who's ex-Bridgewater, Paul Brodsky, and Dennis. Paul's out in New York, so if you're ever in New York, feel free to ping him. And then Dennis works on kind of order execution, trading, that sort of thing. So if you look at the history of money, originally it started off with these sort of small assorted items that were essentially commodities, whether that's a stone in the case of the App Islanders, or whether that's an actual metal in the case of gold and silver. And for the longest time, really thousands of years, it remained essentially these sort of commodity currencies. People would mint coins, but they're usually almost always made out of some metal that had underlying value. And then it didn't really start until the kind of early 1900s that people started creating, or 1800s or so, that people started creating currencies that really got tons of traction. If you look at things like the British pound, eventually the dollar in the early 1900s started getting traction as a world reserve currency. And these currencies, the big thing that was different is they weren't fully backed. And then eventually they lost their backing entirely. So if you look at the pound, it basically lost the gold standard backing actually multiple times before finally going off the gold standard during World War II. And then the dollar officially lost it in the 70s, but for practical intents and purposes, had lost a full peg well before that. And so you had this kind of progression of money where it gets more and more abstract. So at the very beginning, money was kind of this rock solid thing that you could hold in your hand, literally rocks. Eventually it became metals, then it became paper. And then with Bitcoin and digital currency, it's become kind of bits of information. So it's even more abstracted. And so it sounds kind of weird that money would become this sort of very abstract thing. But the progression of money has gotten simpler and simpler in a sense where the actual item that represents it is very simple, even if the underlying monetary system is quite complicated. And then in 2016, another big shift happened, which is that not only are we seeing digital currencies, but we're seeing digital companies. So these sorts of decentralized applications built on platforms like Ethereum and EOS that allow people to engage in commerce without having to trust central company. And so one thing Milton Friedman said is that a big kind of missing piece of the internet is a protocol for electronic funds transfer. So transferring funds from person A to person B without A actually knowing who B is or B knowing who A is. And Bitcoin essentially filled that missing piece. And so if you think about kind of what the implications of this are, Bitcoin is essentially money over IP. And if you look at any other kind of approaches towards sending value on the internet, they're always one layer removed. Like even PayPal still has to interact with the legacy banking system at the end of the day if you want to do a transaction over PayPal. But with Bitcoin, at least once you have Bitcoin, it really is purely electronic when you send it from one person to another. So if you look at how voice over IP routed around the telephone monopolies, we still have telecoms, but they're kind of shadows of the companies that they once were. And I think the same thing is happening with money. And so the kind of companies that will get disintermediated here are companies like correspondent banks that route payments around the world. And basically replacing those rails, which take days, are very expensive to use, and kind of force everyone to be routed through them, will instead have this more open protocol that's much cheaper, lower friction, and open to everyone to use, and is very easy to use. Not only is it easy, but it's also fast. And so if you look at disruptive technologies in the past, people always kind of call them category killers, in the sense that they go after kind of one category and tackle that really well. And if you look at blockchain tech, it kind of has the opportunity to go after a bunch of different verticals, similar to how the internet didn't just transform newspapers, it transformed a bunch of different industries. And the kind of key important thing here is that it's not going to happen all at once. So first you had kind of concept of cross-border money movement, then micropayments, then peer-to-peer, basically smart contracts and decentralized applications. Eventually you'll have decentralized applications or organizations that function without a central leadership. And then the release of Filecoin later this year, we'll have immutable data storage, so you can pay for data storage and kind of get access to it anywhere without having to go through a central company like AWS. And so if you look at the size of the opportunity here, the cryptocurrency market, it's still very small relative to the kind of total addressable market here. So if you look at what Bitcoin's doing, eventually it's not inconceivable to imagine that central banks would hold Bitcoin similar to how they hold gold today, and that average consumers would hold Bitcoin as a sort of stored value. And then that's not even considering all the applications of actually disrupting companies, kind of the structure of the firm, everything around that. And so the total addressable market for this is very large. It includes global remittances, global payments, and then of course store of value and gold. And then eventually you start to kind of eat away at money itself, because one thing that's really important with blockchain tech is it finally provides the ability to have money without it being directly connected to a sovereign. And in the past, that was actually true to some degree. If you look at kind of coins minted by the Roman Empire, they actually still held value even after the Roman Empire collapsed. And the reason was because they actually had real value in the metal in them. But if you look at money today, if a government collapses, the value of that currency created by that government essentially becomes worthless. And so Bitcoin is essentially kind of returning to the idea that you can actually have separation of state and money. And so the question then becomes, okay, well, why not just buy Bitcoin? And I think the reason is, Bitcoin is about half of the market these days. There's different approaches towards creating essentially competitors to Bitcoin, whether that's on the privacy side of things. If you're actually transacting with money, you really do need your transactions to be private. Most people would not feel comfortable if everyone in the world had access to their entire bank account history or their entire credit card account history. And that's kind of how Bitcoin is today. So one is approach is trying to do things in a private fashion. The other is people just trying to do things differently, whether that's differently on the scalability side of things, trying to do higher throughput so you can actually do more transactions and do more payments, or people trying to do smart contracts, which is where you get into the ideas from Ethereum and decentralized applications. And so if you look at Bitcoin, it's really kind of solidifying itself as a sort of digital gold. But for all the other use cases that you mentioned, like cross-border money movement, payments, decentralized apps, decentralized organizations, all that sort of stuff today isn't really happening on Bitcoin. And so if you look at some of the kind of fundamental tenets of the cryptocurrency movement, one is that it's much more inclusionary than previous things. So whether that's crowdfunding of new projects, or whether that's kind of just more concretely cryptocurrency, Bitcoin, Ether, et cetera, is one of the first few assets that retail investors were able to buy actually before institutional investors. And so that doesn't happen very often. Usually it's the other way around. Other things, because these are all peer-to-peer and relatively pseudonymous, is the kind of like structures of power is such that people are rewarded more for actual raw talent and creativity than having money or connections. And this is kind of an interesting concept, because if you look at Ethereum from the outside, lots of people think that, well, it's just kind of run by Vitalik. But if you ever actually try to get something done in Ethereum, try to get some improvement added, it's very clear that it's actually not run by Vitalik. He doesn't really have very much power, despite the fact that he created the thing. And that's a really powerful concept. And as far as kind of what changes do get implemented in Ethereum, it's mostly based off of what has the most technical merit, what's actually useful and going to kind of improve Ethereum, as opposed to what the Vitalik said it was a good idea or not. You also see this actually in Augur as an example. But Vitalik was staking on one of the outcomes in the market, and the rest of the reporters just disagreed with him, and he actually lost his stake. That's a really powerful concept, because if even Vitalik can't change the way one of these systems works, because the kind of crowd has a different viewpoint, it shows that these really are truly peer-to-peer decentralized systems. And another big thing is that we talked about contributor run. The other interesting point is that users actually capture kind of more of the value here, because if you're a reporter in Augur, or a staker in Ethereum, or if you're a liquidator in Maker, you actually get the rewards from doing that. It doesn't just go to some company like a Facebook or Google. And so if you look at what's a bit different than the internet, the internet protocols didn't really have any monetization layer, because of the fact that the protocols on the internet were essentially stateless. And so what that means is they're just kind of like a recipe that you follow for doing some sort of action. And they didn't really touch money at the core level. But if you look at the blockchain space, the protocols aren't actually stateless. And so what I mean by this is they actually store data about the sort of historical transactions you've done, or they store data like how much money's been deposited into this contract, who's betting on X at Y odds, who has a collateralized debt position in Maker who's about to get liquidated, all those sorts of things. And those have value associated with them. They're not just a simple recipe to follow, but they're a recipe kind of almost with the ingredients as well. So that's one big difference on protocols in the internet versus protocols in the blockchain space. And so because of that reason, you see a lot of value actually going to the protocol layer. And so if you look at the value split here, it's about 80-20. It used to be about 90-10 than the kind of large market drawdown. With that, now it's more about 80-20. About 80% of the value is in the protocols, and then about 20% of it's companies on the application layer. So companies like Coinbase or Bitstamp or Brave as an example. And so if you look at the difference between Bitcoin and Ethereum, Bitcoin is really one thing, which is global value transfer. So sending money across borders or within a border without having to trust the other party. And while also solving a really important problem, which is making sure that you can't spend the same money twice. It's kind of a classic counterfeit problem. And then if you look at Ethereum, the main problem it solves is value transfer with conditions. And you can use those conditions for a bunch of different things. If you think about the whole financial system today, it's really just built upon the idea of value transfer with conditions. So If you place an order to buy a stock, well, you're really just saying, I'm willing to buy the stock at Y price. And if it doesn't go up to, if it doesn't go to Y price, I'm going to cancel my order. Or, you know, value transfer with, say, a derivatives contract is, if you're right, you profit from it. If you're on the wrong side of the contract, you lose money and it goes to the other party. So these are two really simple things you can do with Ethereum. And so if you look at the sort of economy that this creates, one thing that it does is it creates a sort of peer-to-peer decentralized financial system, but it also creates a sort of peer-to-peer decentralized information economy as well. And so that's everything from, you know, decentralized versions of applications like Airbnb and Uber, which is what Origin is trying to solve, to things like online gaming, which I think is going to be a big area in the blockchain space as scalability starts to improve. You know, projects like Virtued Poker and Funfair, and then all the way to things like storage in the case of Filecoin and IPFS, or even the browser in the case of Brave, where they're doing a really cool thing, which is trying to basically take away the concept of one centralized ad marketplace like you have with Facebook or like you have with Google in the case of AdWords, and make that more peer-to-peer and make it an actual marketplace with kind of an open order book that anybody can participate in. If you look at Google's ad marketplace, what's weird about it is it's a one-sided marketplace. The same thing is true for Facebook's ad marketplace as well. They're selling you the ads, but you can never sell ad space. You can only buy it. And that's essentially like kind of how the bookie model works with betting. And the whole bookie model was revolutionized when a company called Betfair came out and basically said, what if you allow people to trade with each other? That's never happened yet for the ad market. And Brave is essentially working on that problem. So it's a really cool company. And if you look at the sort of things required in a more open financial system, you really need one really important thing at the base layer, which is a sort of unit of account. So something that you can use to transact in. And I don't think that currency is going to be, you know, Bitcoin or Ether. The reason is those currencies are far too volatile. Instead, you know, Bitcoin or Ether are more like the gold to the dollar in this analogy. And so what you need is a stable unit of account. And one really promising approach that's actually doing very, very well is MakerDAO's DAI. And what DAI is pegged to basically the US dollar. But it's done in a decentralized fashion where it's backed by reserves of other cryptocurrencies. So that's a really cool project. It's also synergistic with assets like Ethereum and Bitcoin, because you could envision, you know, someday where people are using Bitcoin to back as a reserve for creation of new currency like DAI. And you also need exchanges to actually trade assets. Projects like 0x are kind of building out this infrastructure. Right now, that layer of the infrastructure is pretty immature because it's pretty slow. And then you have actual kind of assets. So whether that's issuing underlying assets in the case of issuing, you know, tokenized securities, tokenized debt, or whether that's derivative assets where you're basically just essentially betting on something with somebody else where there's no actual underlying asset. That's kind of the main layer that most people interact with, is the exchange and asset layer. And then there's two kind of features or benefits that you want when using that layer, which is margin and leverage. And if you look at the financial system today, there would be much lower volumes, much less usage if you didn't have the kind of primitives of margin and leverage. Both those are hard to do in a decentralized fashion, but people are working on those problems. And so if you think about our thesis, at a high level, really the idea is that what this tech is creating, you know, isn't just one or two things, but really it's an entirely new kind of parallel financial system. And what's weird about that is it's kind of a weird concept. You know, you wouldn't expect the average person to kind of wake up one morning and think, wow, I wish I could, you know, create a new custom financial contract. And that's kind of similar to how you would never have, woke up one morning and thought, wow, I want to create a book, or I want to create a magazine. But primitives like the printing press are still very, very useful, because even if a small amount of people want to create a new version of something, those kind of small new ideas and small innovations can spread quite rapidly. So this idea can kind of affect anyone from the farmer in Argentina who wants to hedge against drought risk, but can't find an insurance provider who's willing to insure his farm because it's just too low of a dollar value amount, all the way to somebody who has a really specific trade they want to make. They think that X will happen given Y conditions by a certain date. These are all sort of things that you can do custom on top of platforms like Ethereum that you couldn't really easily do in the existing financial system. You would have to, call up an investment bank, have them write you up a very custom contract, and then hope that you could find a counterparty kind of OTC. Whereas in this world, the idea is that you can create that sort of system for a few dollars, basically using point and click interfaces. And then, if nobody shows up, nobody shows up. But it allows you to test more different ideas for different types of markets and marketplaces. So it kind of brings the cost of experimentation way down. And so we're basically investing in projects that are trying to bring that vision to fruition. And it hasn't played out yet. And we think the reasons are that a lot of these apps actually exist. They're just very slow and very difficult to use. It's like the internet in 1990. Everything was super slow. And, maybe some of the stuff we're trying to do is more like streaming MP3s. And, maybe that's a few years away. But I do think the scalability in this space will happen quite a bit faster than it did in the internet. Because in the internet, people had to actually lay physical copper wire. Whereas here, they have to solve technical problems and release kind of technical code-based solutions. They don't actually have to, lay physical infrastructure for the most part. And so going over our fund strategies, the ICO fund is investing in basically new projects in the cryptocurrency space that are selling a currency or token. And the minimum for that fund is 100,000. There's monthly subscriptions and quarterly redemptions. And then the digital asset fund is multi-strategy, but right now it's primarily in kind of a fundamentals-driven discretionary strategy that's buying assets that we think will benefit most from this thesis. And the minimum subscription is 100,000 on a monthly basis, with redemptions on a quarterly basis as well. One note on the ICO fund that I neglected to mention is that it's quarterly with 12 months prior notice. And then with the digital asset fund, it's quarterly with 65 days prior notice. And then the last one is the Bitcoin fund. And the idea behind this one is if you want exposure to kind of the core base digital gold idea, this is where you would get that exposure. It's a 75 basis point management fee, $100,000 minimum, and subscriptions and redemptions are daily with 1 day's notice. So it's pretty easy to get in or out with a relatively, if you want to get a large amount of Bitcoin or sell a large amount of Bitcoin, the Bitcoin fund's a really easy, straightforward way to do that without having to, hold it or manage it yourself. And so if you look at the main takeaways from 2018, the kind of last year, we've seen a few things. One is that projects are taking longer to go live due to two concerns. One is regulatory. They've been waiting until the regulatory environment clears up. Some of them have been waiting until it's been 1 year since they last raised capital from accredited investors. The idea being that they can try to comply with Rule 144. And then the second reason is the market's down quite a bit, and some people are waiting to launch until we see a bit of a kind of grind up in the market first. The other thing we've noticed is there are a lot less projects in 2018, but the ones that we did invest in, that we did see, were a lot higher quality. And so the kind of concept of investors who just pumping and dumping assets are gone. Lots of the scam and useless token projects are gone at this point. We also notice kind of premature regulation is still probably one of the bigger threats to the market. It's kind of our belief that the tech needs to improve quite a bit and it's kind of reach a point where it's mature enough before regulation happens in a serious fashion. And the reason is even the developers don't necessarily know how this tech is going to evolve or how it will mature. And so it's really hard to think about how to regulate it unless you just let it mature a bit before actually, creating rules and guidelines that actually make straightforward common sense. Also, we saw a huge kind of surge in stablecoins in 2018. On the decentralized stablecoin side, MakerDAO is really the clear winner. It has about 2% of all 2% of all Ether is locked up to create DAI, which is a stablecoin. So basically 2% of ETH is in the reserve system for MakerDAO, which is a pretty high amount. And then the last one is that smart contract demand is there. The problem is just huge user fall offs due to the fact that it's really difficult to use. Things are slow. And kind of dealing with Ethereum, getting access to Ether, all that sort of stuff is still hard for the average person. And with that, I'm going to pass it off to Dan.
Thanks, Joey. So we have a few slides on the ICO market itself over the last few years. And the first one is just the number of deals and the amount of money going into the space. And unfortunately, it only goes through Q3 of last year, so it's not fully updated. But it just graphically depicts the huge inflows that we had, when people were just super focused on ICOs, and it really took away from venture at the time. And now venture's essentially making a comeback as people are using venture. The next slide is a better graphical representation of it. There is a perception out there that essentially ICOs were invented at Token Summit 2017 or Consensus, and that the ICO thing happened and it's gone and it went away. But the reality is, as you can see from this graph, is ICOs have existed since 2013. Important ones like Ethereum and Augur happening, but they're very rare. And essentially that's our view, is that ICOs are still an incredibly important way for decentralized protocols to raise capital to build themselves out. But ones that actually have utility and that are very important are going to be, they always were rare. That gold line at the bottom of the graph is the number of ICOs that Pantera has invested in. And it's going back to very rare. So we're seeing good deals, but only every few months do we pull the trigger on one. And on the next slide, we have just a reminder that ICOs take a long time. And there was a kind of, I think, an unrealistic expectation that when all these ICOs were launched 18 months ago, that they would be able to do really cool things immediately. And Joey's project, Augur, took 4 years from when the idea was conceived to when it went live. There's a lot of tools out there now that will probably make these timelines happen a lot faster, but it's still going to be 2 or 3 years. And investors in the space need to be conscious that it's going to be a bit of time until many of these projects go live. So the fundamentals in the space on the next slide have changed. That now there's some massive multinational corporations that are engaged in blockchain. It's really a very different environment than it was a couple of years ago. These firms like Starbucks are actually investing in cryptocurrencies or exchanges and are going to make it just more institutional, allowing a bigger base of investors to get into it. And then the last few slides are just some perspectives on the market. Cryptocurrency is unfortunately very much like early stage venture with a real-time price feed, and that has some positives and certainly has some downsides. So this is a graph of the price of Bitcoin as a proxy for the market, priced in log terms, so it's, you know, exponential. And from there, you can see it's actually relatively steady growth that when you graph it in absolute, it looks like a, you know, vertical hockey stick, but that's the way all disruptive technologies look. In this case, we had a very, very long bull market. There's been 7 bull and bear cycles in the price of Bitcoin. This is trying to put some perspective on how deep this bear market has been. On the bottom of the graph, cycle 7, we've had an 81% peak to trough decline in the price of Bitcoin. That's compared to an average of 62% and a median of 69. So this this cycle's been deeper. It's basically exactly the same as the last cycle that troughed out in 2015. And then in terms of the length of it, it as well is almost at a record. The average bear market's been about a half a year, and then the median one's been only 3 months. And this one is a year and a month, and if it persists for another month, it would be the longest in history. So again, the past doesn't absolutely predict the future, but it's a good yardstick. And then the next slide is a reminder to try to think about buying low and selling high. And it's really hard for most of us, myself included, to do this. And this is a graphic of the inflows into our Bitcoin fund, again, as a proxy for the market, over the 2 big price cycles. And the gold bar, and the top one is the first boom and bust in 13 to 15. And then the second one is 2016 to present. And the gold lines are the percentage of time that Bitcoin spent in each of those price ranges. And then the black line is the amount of inflows we saw to our fund, you know, during those things. And it shows that in the first era, very few people were investing when it was down at $65. And then when it got up to 300 or 400, people started investing. Above 500 is when real money started flowing in. And then a huge chunk of it came in at 900 or 1,000. And the market went down and stayed down for a couple of years, around 200 or 300. And on the bottom there, you see that, you know, very few people invested when it was low. And then finally, when it was, you know, ripping above 5,000, you know, everybody piled in. And that would just be a, you know, a perspective to you know, try and view this as a very long-term trade and kind of try and catch some of the lower cycles and then hold on to it. And the last graph is just the price of Bitcoin over all these different cycles, graphed log with a regression through it. And over long periods of time, and, you know, I've been in this business for 7 years, so I've seen a lot of these cycles. It really does often get back to its long-term trend. And I know it sounds crazy today to say, but if it did get back to its trend at the end of this year, it'd be at 68,000. And although I'm not sure that's a 50-50 bet right now, but I think it is actually a pretty decent chance that it gets there. And on the next slide, we have the terms of the fund. I won't go over them, though. We'll share this presentation with you so you can get all this afterwards. And with that, I'll open it up for questions. Some of the questions have been answered on the chat box. You know, keep asking them there if you would. And then if you want, you can unmute and ask a question verbally. And then my partners and I will stay on for as long as there are questions. So, you know, we're happy to stay, but if you have to get on to your next meeting, you know, feel free to hop off. Oh, and a couple of housekeeping things that if a question does come to you after the call that you didn't ask during the call, you can always get in touch with us via our investor relations group. And that email address is ir@panteracapital.com. And then just the logistics on the funds, both of the hedge funds, the ICO fund and the digital asset fund, accept subscriptions each month at month end, and investors come in at the net asset value of the fund. And then the digital asset fund has quarterly redemptions on 65 days notice. And, so each month people can come in, and then each quarter people can submit a redemption. And with that, I'll open it up to questions. So there's a question on the supply of Bitcoin is being limited to 21 million, but the non-believers say that you can fork it as many times you want. And so it really isn't limited. And this is an important question. And it used to be really easy to answer this and kind of dismiss the non-believers. There've been a few too many forks, over the last couple of years. So it's not as clear, but it reminds me of a time I was on Squawk Box, and Andrew Ross Sorkin was being super negative about Bitcoin. And he said his wife and he were walking down the street, and some guy had just invented a new cryptocurrency of his own. He was trying to sell it, and that he and his wife decided, what they would do is they'd make their own cryptocurrency and sell it. And given that anybody can make their own cryptocurrency, there's no value to Bitcoin because there's just a million or unlimited copies of it that can be made. And I said, hey, no, wait, I got a better idea for you and your wife. Photo sharing. If you can get 2 billion people to share photos on your website, you're going to make a ton of money. The problem is Facebook already has all those people. And so it's really hard to launch a new photo sharing website. And that's basically the argument here is Bitcoin already has 50 million people or so using it. And so although it's just open source software and you can copy it, you can make your own version of it. It's really, really hard to get 50 million people using another one. And the thing to keep in mind is currencies and technologies both have very strong network effects. And if you have a technology currency like Bitcoin or Ethereum or Ripple or whatever, those have very strong network effects. And so it really, really does matter that how many people are using it. And the way to put that in perspective is if you literally are the last person on earth to use a BlackBerry, it doesn't matter. It still works great, right? You can call anybody you want, you get incoming phone calls, it's all fantastic. If you are the last person on earth to use Litecoin, it doesn't work. You need the network of people accepting it. And that's the same with fiat currencies. The US dollar is basically global currency that you can use in the jungle of Borneo or whatever. Everybody will take US dollars. So that would be the answer. There's an unlimited number of copies of Bitcoin, but it's pretty tough to make one that supplants it. And I'll take a shot at the question about Bitcoin as a currency versus purely a store of value, and will it ever become efficient enough to become a true currency? So the reason I think blockchain assets like Bitcoin or XRP or Ether are really important things to invest in is they can do dozens of different use cases, not just currency. And actually, currency is one of the last things that Bitcoin's going to do well. Because the technical definition of a currency has 3 attributes, and one of the criteria is that it's stable, and so it's a good unit of account. And Bitcoin is very volatile because it's young, and there's only 50 million people using it rather than 2 billion people using it. So I think that Bitcoin itself will probably not scale like some of the other blockchains, and so the kind of retail use of crypto will have to be either an off-chain solution in Bitcoin or on another chain like XRP already does 1,500 transactions per second. And then the other issue with Bitcoin is, it really does consume it will consume 0.2% of the world's electricity, and so that will ultimately make it difficult to go up, more than say 25 times or something like that. And Joey or Paul or Lauren, if you have a different view on Bitcoin as a currency, feel free to hop in. Oh, there's a question on the state of concentration of Bitcoin ownership at this point. There used to be some good academic research on it. I haven't seen it, anything lately, so I wouldn't want to get too over my skis on making any assumptions or any statements on that. Oh,
There's a question about proof of stake with Ethereum. I still think proof of stake on Ethereum is a ways away. You know, like probably like 2 years, to be honest. The kind of technical progress there has been slower than people thought it would be. As far as number of participants in the network, you know, I think there will be over 1,000 people staking on Ethereum once it does happen. I just think them getting a technical solution that kind of meets all the criteria and makes everybody happy is farther away than most people in the space think right now. As far as price, it does affect price to some degree because it'll make Ether a yielding asset, which is pretty interesting. I'm excited for there to be more and more yielding assets in the space. So I think that's going to be a good thing. And then we'll also see some proof of stake networks launch later this year, like Cosmos is supposed to launch, as well as Polkadot, both of which are proof of stake networks that we'll finally be able to see kind of how the economics works in the wild.
Oh, there was a question on the connection between the Fed's balance sheet and crypto. This is Dan. I spent a whole career trading currencies and studying the Fed and bonds and things. And I actually am less convinced than a lot of people in the crypto space about the direct link between the two right now. I think it's just so early in the crypto asset era. You know, we're only 10 years in and most people have only been involved for a few years, that I think it's still probably pretty disconnected, that, you know, the Fed can do what it does and crypto will go up or down kind of independent of the Fed. I think in the long run, the debasement of fiat currencies, you know, which has been pretty staggering. Even the US, which is, you know, one of the least crappy paper currencies out there, has lost 90% of its purchasing power since 1950. And in my lifetime, quarters were made out of silver, right? And pennies used to be made out of copper. And the currency's been debased so much that it now costs more than 1 cent to make a penny. Oh, and the other stat that we put in the investor letter a couple months ago, September investor letter, is it takes 174 pieces of paper British pounds to buy a pound of sterling silver now. And, you know, that's pretty much the clearest way to show that, you know, the pound has been debased 99.47%. So I think it's going to have a very long-term impact, and people will be investing more and more of their wealth in digital assets and less of it in gold or paper money. But I don't think, you know, the Fed announcing they're going to let the bond program mature over the next 3 or 4 years has any real direct impact. And the question about valuation is just like in other kind of early stage markets, you know, like venture versus public equities, there's actually kind of a 9-month lag between valuations in the public markets and then valuations in the, you know, the private markets. And what, as supply and demand curves would imply, that if the prices aren't coming down but the demand is coming down, then the number of transactions goes way down. And so that's one of the other reasons there are very few ICOs happening now, is the projects still all want kind of the old prices, but buyers don't want to pay the old prices. They want to pay something that's akin to the, you know, the secondary market. And so the number of transactions goes way down. And we're doing the deals where the developers, you know, have a realistic expectation and are willing to do it at the correct, you know, current price. But we passed on a lot of deals where the developers were still waiting for the kind of 2017 price to come back. And the question on OTC derivatives in the crypto space, I haven't kept up with it terribly closely because I really just am not a huge believer that OTC derivatives are going to be important anytime soon. the way I think of it is, Bitcoin itself is like a call option on a future payment rail of the world. So, you don't really need an option on an option. It's already so levered, it's already so volatile that, so I think it's going to be relatively slow to play out. And we've even seen that in the futures market, that less than 1% of the value of the entire industry is in the open interest of the CME and CBOE futures, which are, just linear derivatives. So, I think it's going to be relatively slow. And that's the way it is in the fiat market. Almost all foreign exchange is traded on a spot cash basis, and very little of it's traded on a futures basis or option basis. And the question of economic slowdown impacting our companies, most of our companies, I think, are pretty immune either to the upswings in economic activity or downswings. It's such a new asset class, and it's so unconnected that exchanges or cross-border money movement companies, or right now we're investing in a lot of scalability projects. Those things are pretty disconnected from non-farm payroll or whatever, the kind of normal statistics in the economy.
Well, the question about improvements in Ethereum scalability. Yeah, I think we'll see improvements in scalability before proof of stake. I was just saying that I think proof of stake is 2 years away. But I think on the scalability side, there's a couple projects that are close to launching on that angle. One is Gluon Plasma, which is a Plasma implementation. There's also another Plasma implementation called Matic Network. And then Cosmos is supposed to launch sometime, really in the next few months. And then Polkadot is supposed to launch at the end of this year. They've hit most of their deadlines for their test network and their beta networks. So, I imagine that their launch timeline is relatively on track still. So I think we'll see most of those projects launch this year, all of which are scalability kind of in the Ethereum arena. On the question about what happens if there's another financial crisis or recession within the next couple of years, how do we think that will impact the cryptocurrency space? I think a lot of people have this idea that crypto will go up at that point. I personally think that it'll be more of a negative impact to cryptocurrency than a positive one, because of the fact that right now crypto really isn't mature enough to be viewed as a safe haven. And so when the market's choppy or when the market's going down in regular public markets, I think people view crypto as a risk-off asset, where they're going to take a risk-on asset. So they're going to take their risk off when the market's going down. They're not going to invest into crypto as a sort of safe haven. I think, if you look at a 10-year horizon, that probably changes, and cryptocurrency does become a sort of safe haven, where if public markets are choppy, you go into crypto, you go into Bitcoin or something. But I don't think we're there yet. There's a question on like rehypothecation and commingling of crypto assets. So, crypto assets have always kind of been commingled. If you look at Coinbase, they've been around since 2012 or so. All of their assets are kind of in commingled accounts. They're not in segregated accounts, and I think that's fine for certain use cases. It's probably much safer for Coinbase to figure out a really solid strategy for storing all their crypto in cold storage, as opposed to figuring out a strategy that allows them to store every individual user separately. From a security standpoint, the second is a lot harder. In terms of rehypothecation, I think it's just part of a maturing market. The cool thing about crypto is if you don't want your assets to be rehypothecated, you can store them on your own wallet. and you can prevent that from happening. The kind of downside of the legacy banking system is that you can't prevent that from happening unless you just, get cash and store it under your mattress, which isn't very safe, and a lot of banks will reject cash these days over a certain amount anyway. So I think the cool part with crypto is you basically maintain that choice. And with that, I think we're gonna wrap it up. Thanks everyone. If you have any additional questions or something comes up, feel free to just shoot us an email at ir@panteracapital.com. Or if it's something, technical or about a deal, feel free to email Paul or myself. All our emails are just our first name at panteracapital.com. Thanks.